Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Toolmaker Stanley Black Decker stock is on a lot of investors' radars right now, and for good reason. The dividend yield is way up. This is a company that's raised its payout every single year for 55 years. Stock's also down almost 60% from its high, and there's some real concerns investors probably need to know about. Plus, we might have a better stock idea for you. I'm Jason Hall. This is The Smattering. I've got Tyler Crowe here with me. Tyler has that better stock idea. Hey, Tyler.
So yeah, Stanley Black Decker. One of the things that's, when you think about Stanley Black Decker, is the suite of tools that it has. Obviously, you've heard of Black Decker tools. You've heard of Stanley. They also own DeWalt, Craftsman, and they've been on a bit of a buying spree over the past decade. I just mentioned Craftsman, which they bought from Sears. They're been getting into lawn products. They're making an acquisition of a company called NTB. You know, there's some combination of basically anybody that is a DIY person and to a lesser degree, tradespeople making acquisitions into tools. Stanley Black Decker wants to be the go-to company. Now, that's great. The unfortunate thing is when you're making a lot of acquisitions, you have to do them just right. Otherwise, you know, your cost of acquisition or the cost of your incremental revenue goes way up. You're taking on debt. You're doing a lot of things to make that possible. And that's where things are getting a little tricky for Stanley Black Decker. After this kind of spending spree, we're starting to see things like, you know, terms that come up when things aren't going right. It's selling non-core assets, trimming debt loads, you know, or trying to right size the balance sheet. A lot of those terms that you hear when all is not right.
Things become non-core assets when you make a bad acquisition decision 5 years before.
Exactly.
Right?
You know, that's all of a sudden all is not well in the state of Denmark. But so what I wanted to do was propose an alternative here because in this tool industry, because I think a lot of people are going to gravitate towards this because the stock is down, the yield is high. Oh, well, you know, it's paid a dividend for so long. How could you possibly go wrong with it? I would like to offer the alternative as company Snap-on Incorporated. Snap-on makes tools as well, but the biggest difference for them is they're not a DIY.
They market directly to professionals.
They are tradesmen professionals, and use a bad analogy, they're kind of the Rolex of tradesman tools. Because if you see the price tag on some of the things that they sell versus, you know, going into a Home Depot and buying, you know, a Ryobi or something like that. You know, we can talk about the fact that they're higher cost or whatever and maybe price sensitive, but that hasn't been the case. Snap-on has just been a company that's like, we're going to stick to our knitting, and it has been incredibly lucrative for them. You know, over the past 10 years, we're just doing a comp here, you know, after all those acquisitions that I mentioned for Stanley Black Decker over the past 10 years, revenue at Stanley Black Decker has grown 73%. Compare that to Snap-on. No major acquisitions, just kind of stick to its knitting, and its revenue is up 50%. So, you know, for all of that additional M&A and activity, we didn't get a huge, you know, disparity in revenue growth over the past 10 years between these two companies. But the big difference also being Snap-on is immensely more profitable than Stanley Black Decker. As of the most recent trailing 12 months, Snap-on has a greater than 20% net profit margin versus less than 10% for Stanley Black Decker. And, you know, even though it's a considerably smaller company, Snap-on is about $5 billion, but only had $400 million in debt. So it hasn't been adding to it, has been buying back shares, pays a much more modest dividend. It's a stark difference. And a lot, like you're saying, a lot of these acquisitions that it's made recently has sent its debt levels to levels we've never seen before. You know, this was a pretty conservatively run company for a really long time, and then they went on this spending spree for a decade, and now all of a sudden it feels like the check's coming due. I don't know if this is going to portend a dividend cut, but it is one of the more challenging times in Stanley Black Decker's 50-year history.